You had predicted Trump will come to power, RCB will win the IPL, the market will fall 20% at some point in the next year. You did predict this 2008 crash. Do you see one happening now?
There is going to be some kind of a crash. And that crash is probably going to be driven by two layers. AI may be responsible for it, but when Nvidia buys stake in something that buys Nvidia processors. And then you think over this and say there's a cascade. That effect is happening right now where they're manufacturing their revenue through investments.
Every time in India, you've tried to call out that there may be a correction in real estate.
Real estate prices are impossible to predict meaningfully in India.
The interest rate cycles per se, it seems that you frequently got this right. So how do you see this playing out from here, interest rates from here? And is there any chance we could make money off of this?
The reason it's easy to predict it is because when there's a cycle, rates go up 2 years at a time and rates go down maybe 1.5 to 2 years at a time.
Japanese debt eventually becoming a problem.
Japan is a bug looking for a windshield. It's been 30 years and that bug hasn't found that windshield. And it's possible that it'll never find it. But the peculiarity about Japan is this.
India will see a big 20% up move and maybe even hit 30,000 on the Nifty before next Diwali. Gold will crash more than 20% from the peak, silver too. The US will see a recession and inflation at the same time. Well, I mean, you are putting your neck out there.
This is probably the only time I'm going to be openly predicting something.
Deepak, I took a look at your predictions for the last 17 years. It was quite a fun exercise. I'll have to say, it started on a very promising and almost shocking note, where I went to your 2024 predictions, where you had predicted Trump will come to power, RCB will win the IPL, and the market will fall 20% at some point in the next year. And well, all three of those did happen, even though the 20% correction was very short-lived. I think only a month or something like that, or 2 months. So then I said maybe I should start all the way at the beginning with the 2007 predictions and start. And the 2007 prediction said that the stock market will crash next year, which it did. So I have to say, after these first two articles, like, where have these predictions been all my life? And I now need to frame all of them and learn patterns. But then, of course, I went through the remaining 17 years, and I think the record has been a little more mixed for 15 out of the 17 years or something like that. So it was just the beginners and most recent luck. But coming to it, I did find some patterns across these 17 years of predictions and topics that you've come back to repeatedly or that I feel apply to today. And I wanted to maybe start there. Can I start with a crash? Since we've last recorded, the US stock market has continued almost relentlessly to go up, while India has started to show some green shoots of recovery and life coming back here. I think it's often been mentioned that when there's a stock market crash coming, it speeds up. The market becomes even more hyper and exuberant just before the crash. That sort of seems to be happening right now. You did predict this 2008 crash. Do you see one happening now?
I think our core, at Capital Mind, we keep saying don't predict, respond instead, right? So, but I violate this rule once a year only. And that's why you have 17 or 18 predictions, because that's the only time in Diwali that I allow myself to predict anything. And mostly, as you would have noticed, get it mostly wrong. And when it becomes right, it looks spectacular. And for those few moments, I look like a hero in those time frames. But mostly I have been wrong. So I not only have my predictions, I have the report card of every previous year's predictions in each post. And other than this year in 2007, I mostly look like a fool. So once we qualify that, you should take my words with a pinch of salt. Let's get the words out so we can choose the pinch of salt later. So I think the interesting thing about crashes, and I have noticed that there are two kinds. There's a correction and a crash. And the difference between the two is about how deeply affected the system is in something like this and how long it takes to recover. So a typical, you would think of 2000 as a crash. You would think of 2008 as a crash. But very few of us remember 2013. It was relatively small, maybe 6 or 8 months. 2020, we think of it as a big crash. 38% fall on the Nifty. But within 6 months, we were back. And, again, back in and with some magnificent moves. Many of the others have just been corrections. 2016, there was demonetization, 15-20% down, and so on. And I think to that extent, let's qualify about what I think is going to happen. I think it's very different today. Economically speaking, from 2008, not so much from 2000, but from 2008, because 2008 was a system built with leverage. And when you have a system built with a lot of leverage, you have an issue with that leverage collapsing, because it doesn't mean that somebody just loses their money. It means they lose more than their money and they have to liquidate something else. And then that something else leads to somebody else getting liquidated and so on. So this downstream, cycle or however you may call it, it's like a domino effect. is what causes a crash. We've seen this in the past. 1929, there was personal leverage that caused it. There was a lot of crashes that happened in many other countries, but some of the big crashes have been because of leverage and cascade effects. That one of the cascade effects in 1987 in the US was the presence of portfolio insurance and the inability of people to respond fast enough to a very sharp down move, which resulted in a fall of 28% in a single day on the index. The many of the other crashes have taken longer. So a 2000 crash, and the reason I say that is because I think today we no longer have a leverage problem. It's not like our companies are levered. The top 5 companies in the US have no leverage at all. Uh, Even in India, the top out of the top 5 companies, I think one has net close to zero debt because of a lot of cash and a lot of debt. The IT companies have almost no cash.
No debt.
No debt. Sorry, no debt. Yeah, and there is no meaningful debt in a lot of the auto companies and so on. So there's nothing that tells me that all this is a debt fueled inferno in that sense.
So
That
very
will-
conservative balance sheets in India.
in India and in the West also, a lot of these companies are funded by equity. And these equity guys, you have to just go a little bit further down and say, oh, what will cause an issue over here? So it's a similar case to 2000, not 2008. 2008 was more leverage led, so it led to the fall of a lot of banks, which are inherently levered. But in 2000 as well as now, a lot of the euphoria is being built by venture capital, which is typically equity capital by rich people. So the initial phases are when things start moving. People don't understand the space very well. Things start moving around. People start using the technology that's driving this internet. In 1999, it became so popular that a lot of VC money started funding all of these companies. These companies were going big. They were going public. They were seeing pops of magnificent magnitudes, and the stock market was going up. And eventually, towards the end of 99, or perhaps in the middle of 99, you reached a point where these companies were great, but they were not making any meaningful amount of revenue or growing their meaningful amount of revenue. So what they started to do was to buy revenue from other players. A Cisco would invest in a company and make it buy Cisco routers. They invested in a lot of startups and made them use that money to buy their own routers. So they got the money back as revenue. So what you're investing, remember, is not a balance. It's a balance sheet item. It's not a profit and loss item. So revenue shows up as profit to some extent, right? So to that extent, Cisco is a great company. It doesn't have any debt, and it's kind of lived through the last 40 years or 20 years meaningfully well. But the share price has not really behaved in the kind of manner that you would think that a company that has survived 20-25 years would have. So you would have lost money for a large part of the last 25 years, having invested during that time. Much as I say that, one of the problems that created was the sequence of events seems very similar to today. So you have AI being the big thing, everybody's using it, people are doing. Suddenly you're like, oh, these companies aren't making too much revenue, but so what? Let's invest in them anyway. Oh, they're making some revenue. Then how do they go around getting more revenue? Is when they start investing in other AI companies. So an NVIDIA buys stake in something that buys NVIDIA processors. Oh, this is interesting. And then that other company goes and buys a stake in a third company because they will buy ChatGPT subscriptions. Oh, you say. And then you think about this and saying there's a cascade. That effect is happening right now where they're manufacturing their revenue through investments. I think India went through that phase also in the venture capital world, where a lot of VC funds would invest and then they would kind of do business with each other to a certain extent and shore up their revenue values. But then when that also did not realize meaningful amounts, many of these companies go to the stock markets and say, okay, let's list now and maybe the listing valuations will get good numbers. And when they did that, very quickly in India, the companies found that these valuations don't fly with the public market investors. And very easily you saw that corrections of 40, 50, 60% came in the stock prices of the companies. At least, so the Indian stock market didn't fall so much, but these stocks particular saw a reasonably big correction. I would say the same thing downstream is in the process of happening in the US. So I think there is going to be some kind of a crash. And that crash is probably going to be driven by two layers: recession and inflation in the US. So I think we're talking about that. But I think one of the reasons for recession is that demand isn't actually quite as high as people think. AI may be responsible for part of it, but another part of it is just that you've reached a stage where their geopolitical influence in the US has waned to a substantial extent. That the biggest consumers of the world is no longer the US, is slowly moving to other countries as well. The dollar isn't as strong anymore in terms of a presence. So all of these things kind of put together cause impacts that have recessionary impulses. And those recessionary impulses eventually are also going to be backed by higher inflation, because this tariff thing, although the first 3 months is probably showing nothing meaningful in the numbers, I think it's eventually going to come down to, well, things are going to cost more for you guys. At some point, that's going to have both an inflationary and a recessionary impact. And at the same time, you have this massive funding that's happening on the AI front. If they don't find meaningful sources of revenue and they run out of ways to manufacture that revenue in the first place, they're going to try and come and go into the stock market, flood it with whatever shares they have. They're not going to succeed, and that's going to cause them also to kind of participate in the crash. Remember, when you're privately listed, you don't have to participate in the crash. So I would say that is my prediction, or my prediction for Diwali, which is the one time I do this in the year, is that I think the US is going down in a wire of a recessionary impulse and some form of a crash in at least the big names. But I think I stopped myself at saying 20%. Yeah. I said, no, I don't think it's going to be meaningful more, and maybe one of the reasons is people have cash.
So I wanted to come to that people say, like myself and many others who I know, they have, say, I don't know, 70 or 80% of their portfolio invested, and it's doing incredibly well. I mean, they're looking at new highs almost every week on their global exposure, but they still have this 20-30% cash, and they're like, I don't feel comfortable investing it. And this keeps making you think, so how long or deep can any correction really go when there's like this enormous cash buffers, a wall of cash that's around to be able to buy it when any little blip happens? So
yeah, honestly, I think the cash levels are unfortunately a feature, not a bug. Okay. That means they are a active participant in cash markets, is because you want stocks to fall. It was 2000. In 2000, a lot of cash sat on the sidelines in the late 1999-2000 time frame, saying, if the markets crash, I am going to get in. Then a few startups started to go bust. Then the cascade effect started to happen. The first set of people who put in the money, and most famously, I think Stanley Druckenmiller mentioned this, that he was short through all of the dot-com bubble, lost so much money that by Feb to 2000, he was sick of himself. He not only did he get out of his shorts, he also went long. But interestingly, as soon as he saw the crash happening, he went short again. But in that process, he had lost a fairly large sum of money of going from a short position to a long position and going back to a short position. So he had lost, I think, a few $1 billion or some crazy number like that. So even people who were, more and more confident that they could see this as a bubble, gave up and threw in the towel. And that's when the market kind of crashed. So in that sense, I think cash sometimes works if it's on the sidelines, but usually comes back into the market at the worst time inside a bubble. And if the market falls, this cash doesn't necessarily protect you. So this is not to say that it will be how this time reacts, and markets could still go up 30% before the crash. But I would feel that it is a feature of the crash that people have cash on the sidelines.
Of the crash.
Waiting of a crash. That the people have cash sitting on the sidelines, waiting for something to fall. And initially they purchase it, and eventually they give up on it. But I think this is more a feature of the US than of India. In India, I think people don't have cash, a meaningful amount of it. And when whatever they have, they're using SIPs to get into the market. Mm-hmm. And that is overshadowing almost all of the negative influences that the market has. So I don't think India is due for a very deep crash. In fact, I think my prediction was that it will go up before it goes down.
We should do quite well.
And the US could also go meaningfully up before it goes down. But I feel that the US has more chances of a 20% crash coming here, even from these levels, than India does.
Okay. Another point that you've brought up a couple of times over the last 17 years is Whenever you've tried to call that real estate could potentially have a correction, whether it was in China, which you eventually did get correct and very grandly so, but every time in India you've tried to call out that there may be a correction in real estate prices could fall, or commercial real estate could see some defaults, you've more often than not called it correctly. And it makes me wonder that are there other reasons, without naming names or blaming anyone, but are there other reasons why real estate in India might just not ever be able to be a place where there will be a secular decline? Or does the China experience show us, which you did at some level correctly call out, that there are phases when real estate could become a massive problem for everyone involved?
China is a special beast, I think, here, because China has attached such an big importance to real estate that the stock market hardly matters. The real estate market matters a lot more. A lot of it has to do with a one-child policy through the past, and the fact that people had only one child. So the idea that a person would get married to another person would almost intrinsically make you feel that, listen, you need to own a house, because not only do you have to take care of your parents, you have to take care of your spouse's parents as well. Now, all of them are only children, and by this time, unless you own a house, you could essentially lose a dwelling in that sense. So it's become cultural at some level. It is cultural to a certain extent in India as well. So you do have people who desire to own a home because they feel culturally attached to wanting to own a home in the first place. But there's also the point that finance has made it easier to build houses and all that. I would say in general we have two problems in real estate going on. And I've been so wrong in real estate, it's not even funny. So my saying that real estate will crash, I've realized it at some point there is no concept of a secular crash in India. Everything is local. Prices could crash in Hyderabad, go up in Bangalore. Prices could correct in Pune, but go up in Delhi. So it's a very localized concept. Second, I think the problem that I have identified to a large extent is where there is leverage, which there is no attachment to, which means if you live in a house, you're attached to it, you'll do anything to pay back that loan. And plus your equity is being built in the loan as go on. But if you buy an under construction house and the builder defaults, you have a different problem altogether, because now you've lost the house, but the house was never there. It didn't even happen. You never lived in that house. So you don't have the attachment of that house in the first place. And you don't have any equity because you're probably paying just the interest part of your initial payment and so on. So you don't feel yourself quite as attached. And I've seen a lot of people having serious issues with under construction properties, including in Noida, where a bunch of very, very big, like JP went bust. And JP was one of the biggest builders in Noida. So there were lots of apartments available for a long period of time at a very low value. Now, of course, some of that supply has gone and therefore there's new. I think India is also in the throes of an interesting crisis change. That means in 2020, when there was a COVID crisis, and typically a house of any sort takes 3 to 5 years to build. So when you start a project in 2020, you expect it to be finished in 2023 or 2025, 3 to 5 years. But because 2020 was such a crisis and there was no labor available and people were unsure about their future, a lot of people did not start new projects. They let the old projects complete, but they didn't start new projects. They started new projects only towards 2022. That means there was a two-year period in which there was no supply. Now, that lack of supply has meant that when they were supposed to get complete, which is 2023 to 2025, you don't have enough houses coming up into the supply. And because the demand has picked back up, the supply is not there, you're seeing prices rise in most of the metros across the city. But also at the same time, from 2022 onwards, there have been a large number of new projects that have been launched over a period of this thing. In fact, some of the biggest launches in the last 1 year itself. So I feel that because of this, the cyclicality will still take 3 or 4 years for that supply to seep into the system and keep prices controlled. I don't think there's going to be a crash, but there will be availability. And that availability may, in some cases, in some localities, bring prices down. In other cases, it may not meaningfully allow prices to rise. But by and large, I don't feel that there should be any reason for me to call a crash. You know what a crash would be in India is when people are leveraged up the wazoo, they lose all their jobs, they lose all their income. and they're unable to pay those loans. The banks take over the properties, they put them out for auction. Nobody comes to buy those houses on auction. And the traditional rule is that people have money waiting, and then when they see these opportunities, they'll go jump in and buy them. They don't take advantage of those opportunities, and after that, prices fall to an extent that scares the daylights out of other people who are trying to buy flats, and that's when the crash will happen. I don't see any kind of a macroeconomic impulse that will cause this to happen. Even though people have told me, oh, AI is going to take away jobs and this, well, you know what? It should already happen. But I don't see this happening. I don't see stock price. None of the data seems to reflect that. So I think one layer is that real estate prices are impossible to predict meaningfully in India. And B, I've been so wrong thinking that a lot of fundamental economic principles will work
Apply here.
in the long term. And I've been so wrong about gold as well. So gold is also another one of those. I don't like it. I feel that it's a waste of time. I don't know why it should go up.
But it does anyway. And so
so I am irrelevant to this conversation, right? So in that sense, I think real estate and gold, real assets to the most part.
Although gold has fallen 10% since our last podcast.
Yes, and I have actually written my prediction that 20% it will fall this year.
You're halfway there.
Halfway there. So, but to be honest, I think the problem with any of these things is you can never make an allowance enough for the euphoria of crowds. And I think if prices in Bangalore, for instance, were to fall in any apartment building by 30%, there will be a bigger excitement to buy those apartments today than anything else. It is when you see the situation where people, I think, see prices falling and are still not jumping in to buy apartments or buy land is where things are. And having said that, real estate is so local. So if you go to the outskirts of Bangalore, or maybe closer to where the international airport is, which is more Andhra Pradesh than Karnataka nowadays. But assuming that area becomes developed, it's possible that you get your next 10 bagger or 50 bagger out there, right? But then now you have the risk of, I own land, I don't know where it is, somebody
Let's hope it's still there.
Right? And my neighbor has encroached half of it, I can't do anything about it. All of that stuff is the risk that you take in property when you do these things. But still, I would say secular declines, doubtful. Particular point declines in under construction property in certain pockets and areas where I think the future may not be as bright. Those I think will continue as they have in the past.
Going from one place which you found difficult to predict to one place you found surprisingly easy to predict. So maybe it's just easy for everyone, and it's just something I'm becoming more familiar with. The interest rate cycles per se, and when they would turn, it seems that you frequently got this right, almost down to the month or at least down to the quarter. But it doesn't necessarily seem to translate into a money-making opportunity of any size. So do you know why you've enjoyed such success on this? Is this something that everyone just finds fairly intuitive who's into this space? And then how do you see this playing out from here, interest rates from here? And is there any chance we could make money off of this?
One of the reasons why I think interest rates are easy to predict is because they're a very cyclical long-term concept and they follow inflation. So if you have inflation, interest rates are going to go up. If you don't have inflation, interest rates are going to go down for the most part. The reason it's easy to predict it is because when there's a cycle, it lasts 3 years on one side and 3 years or 2 years on the other side. So rates go up 2 years at a time, and rates go down maybe 1.5 to 2 years at a time. And it's a phase that usually is accompanied by a confluence of factors that make things easy for us to predict. So for instance, inflation is very low right now. It's probably the lowest it has been in the last 5 years, apart from COVID. We've seen extremely low inflation elements. Now, when you think of that and you say, okay, well, what is it? In fact, one of the reasons why inflation is high, even though it's low, the inflation is actually positive is because of gold prices. Because gold ornaments form a part of something called personal expenses or something like that, which is up 19% year on year simply because of gold prices. So if you take that away, gold is not a consumption item. It is mostly an investment item. If you take that away from CPI, which is a consumer price inflation, you might actually say that inflation is not even as high as they say it is.
Which is itself not too high. How much is it, by the way?
1.8 or something like that. So 1.8% per year. And of course, you could argue argue that my inflation is not the same and all that, but we've done enough. So, but if you say that inflation is relatively low and it's transient in that sense, the RBI's choice now is, how do I keep interest rates high at a time when inflation is so low? It doesn't make any sense, because I mean, if I have a loan of 100 rupees and I have to pay 6% on that, that means I have to pay 106 back at the end of the year. Now, if I can produce only, let us say, 100 widgets at 1 rupee each, I have to raise the prices of that widget by from 1 rupee to 1 rupee 6 paisa for me to make money. But inflation in the economy is only 1.5 or 2%. So technically, the economy can only take 2% inflation unless people love my product. So the chances are that, if people's wages are also going up by only 1 or 2%, inflation in other goods is also only 1 or 2%. There's no way I can easily take my widget and make it pay 6%. So in the next year, I don't even have enough money to pay for the interest rate on the loan that I have. So I have positive real rates, which is terrible for me as a borrower, but great for me as an investor. It also means that I could keep my money in a fixed deposit and I will earn more than inflation. I mean, technically not after tax, but still, this is not a useful scenario for an economy for a long time. You can do it for short periods of time, but eventually the RBI has to reduce rates in order to coerce inflation to at least come back to its range, which is 2 to 4% for a large extent. So I would say it has been easy to predict interest rates, because you're almost like, if inflation is falling, you're going to see a fall in interest rates. If inflation is rising, you can see a rise in interest rates. And because it comes so, once in 2 years and 3 years, it's easy to make that prediction of when roughly the switch point is. Two more things. Can you make money out of it? The answer is, even if you predicted that interest rates will fall, it is not that makes the money. Interest rates fell in June or July or whenever it was that the RBI last cut rates by 50 basis points. And when it cut rates, it said that this is a big cut and this is all I'm doing. I don't want to do any more cuts and I'm done. And now we will wait. The market took it as a sign that, listen, you stopped cutting rates. That means your next stop is going to be increasing rates. So the long-term bond prices fell and long-term bond yields went up. They're inversely proportional. So, which means what was a long-term bond yield of maybe 6% went to 6.5%. That resulted in a 4% fall in the bond price. So if you owned, your interest rates fell, but your long-term bond portfolio also fell. So you're almost like, wait, when interest rates fall, don't bonds make money? The answer was no, they didn't. You could predict that the interest rate cycle was going to cause an interest rate to fall, but you could not benefit from it meaningfully. Now, I say this in another way. I think the interest rates are so far away from inflation that we are definitely going to see another interest rate cut. I also feel that this interest rate cut will probably not result in a meaningful drop, because the RBI runs a little scared. The reason they're scared is because of the past and all that stuff. A lot of the past, the
Mistakes
shadow
and
mistakes. I mean, there's
they're going to err on the side of
caution and
yeah.
extreme over caution sometimes. And when they do this, in the sense that they keep looking at, how can we be so close to the US inflation, US interest rates? Who cares? US has much higher inflation than we do in a lot of cases. Why should we? We have never been in a situation where Indian inflation rates have been so close or near the US interest.
Or in this currently looking like lower. I mean,
they're currently looking even lower. So it's almost never been that. So why should our interest rates be higher than them? It makes no sense. So if the US, which is now by the end of the week, this is the last week of October 2025. So by the time you hear this podcast, it might be, over.
One more rate cut would have happened or something.
Yeah, one more rate cut in the US would have happened. That gives the room for the RBI to cut rates. And if the US goes aggressively on the downside, and I believe that they will not be able to too much, because they will see this inflation element come and beat them in the face. India should also follow, but if the US cuts rates, they will follow. If the US doesn't cut rate, they won't follow. And because of this lack of clarity of whether interest rates will continue to move downwards, I feel that the markets are not going to give you meaningfully higher returns. They will get some return, but not meaningfully higher from owning a long-term bond. However, once the US inflationary elements are done, that is when I think Indian interest rates and US interest rates will fall. Those are going to bring the US rates down meaningfully towards the 2%, 3% phenomenon. They're right now at 4% odd. And Indian rate should fall to the 4% rate time frame. That will take a little bit longer. So while I'm telling you, I think interest rates will fall, I'm also telling you, you won't make money out of it by going into long-term.
Well, maybe I can dust up my interest rate future skills or something. But yes, I take your point. The next thing on my list, something I think you've not had a good hit rate with, but I think we all agree with you in a horrified way and are like, this is only a matter of time. Japanese debt eventually becoming a problem. So the percentages have only gone up since you started writing it. They keep doing more and more creative things. That at some point they just started buying stocks outright to support everything. It still isn't a problem for some reason. Do you think we'll be doing this for another 17 years and it still won't be a problem?
I saw sometimes they've done it for nearly 30 years now, and they're still surviving. It is amazing because I think Barry Ritholtz once wrote that Japan is a bug looking for a windshield. It's been 30 years and that bug hasn't found that windshield, and it's possible that it'll never find it. But the peculiarity about Japan is this: it has never seen inflation for the last 30 years. It doesn't know what inflation is meaningfully, and it doesn't see prices going up. But prices are going up now. Part of the reason is because the yen has gone from 110 to the US dollar to 150 to the US dollar. That means the yen has depreciated, the imports cost more, and therefore there's some imported inflation in that sense. This 3 or 4% inflation has caused them to raise interest rates to a certain extent, and the yields on their long-term bonds have crossed 3%. This is where it becomes dicey. The more longer it stays at 3% plus, and the more longer that Japan starts to pay these higher interest rates, there is a point at which Japan's total tax revenue cannot make up even the interest payments on the debt that they already have. It's like saying I've taken 100 crores of debt. I have to pay 6% interest every year, so 6 crores. But my whole business as a whole generates 4 crores of income. Now you're looking at me and saying, dude, you're dead as a duck, because this means, dead as a dead duck. So it's, but it is a problem for you because you cannot meaningfully earn 6 crores to just pay off the interest. Forget the principal. And you want to eventually pay back the principal as well. So how are you even surviving? If the Japanese government does not even make enough tax revenue to pay the interest on its debt, India pays 30% or 40% of our revenues on interest payments, and we are considered a horrible nation. If Japan, I think, should be close to the 50% level now. If it reaches the 100% level, nobody will want to buy Japanese government debt, and other than Japanese housewife to that extent. But I think there's going to be a recession that causes that to crimp as well. So I would say this is a problem. This is a problem that we're going to stare in our face. It's a white swan. So when it does happen, nobody can say, oh, I didn't see this coming. Come on, Japan of all countries. But no, it was there. It's right out there in front of us. It's just that it has been there for so much time. It's like, the annoying noise that you hear once in a while irritates you a lot more than if you hear it continuously. So if there's a fingers on a chalkboard or whatever it is, that's going to irritate you like crazy the first time you hear it. But if somebody exposes it to you all the time, chances are you're like, this
You
is
forget
just
about it.
irritating noise. Until one day, when that noise vanishes, you're almost like, hey, what the hell? That was the most irritating noise ever, and it's gone. And it's, the point is, it was there all along. You knew it. You kind of imbibed it and lived it. So we've lived with this. Japan is a bug waiting for a windshield, and now we're like, the bug and windshield are traveling in the same direction without ever meeting. So we're fine.
Okay. Last one. Rupee internationalization. Baby steps over the last 15 years. I mean, we are more international than we were 15 years ago, but not much.
Well, it was a baby in 2011. That baby is 15 years old and growing a mustache and a beard. And I'm sorry, but baby has continued to be baby steps for internationalization of the rupee. I was talking about it in 2011. I was saying that India needs to start doing steps. Now, at that time, I was in my 30s, maybe 37 or something like that. And I was writing about this and I was saying, this is great. I'm 50 now and we are close to a point where we should have already meaningfully internationalized. But we have done it with so much resistance. we had chances. Iran wanted to use our rupee to do other things. We refused.
I think the US didn't want that either. But anyway, I take
Yeah,
your point.
but we could have done other things,
Yeah.
or to it. Russia wanted to use our rupee to do a bunch of other things. We said no. We said no. I mean, if you had allowed them to do it and the US had said no, that would have been
Fair,
a different
okay.
thing. But the fact is, we only ourselves, oh, how can you use our rupee to do things that we don't want you to do things with? And that's not the way to internationalize, right? So we actually kind of, uh, after the Ukraine war is when we started to realize that, oh, wait a second, they can take all our dollar reserves and sequester them. That means our money is not our money. The crypto coin concept of not your, what is it? Not your wallet, not your coins, or not
something
your,
like that.
So, not your keys, not your coins.
Coins, yeah.
That means if you don't own the coins in a private key, public key combination that you own,
It's not really
your
yours.
coin.
Yeah.
So if we own US dollar reserves, are they really money? Because the US can sequester them anytime they want, and you'll not be able to do a thing about it. How do you change that? Is by not having dollar reserves, and one of the ways to do that is to internationalize the rupee, where you can export in rupees. And when you say that, you mean, for instance, an Iranian person can say, listen, I will buy and I will find rupees to pay you. Now, how do they find rupees? Maybe they also export to UAE. The UAE person may be buying stuff from India and or selling stuff to India where he receives rupees. So they pay Iran and Iran pays us, or whatever it is. So it's like a combinational three-way thing where this is what happens with the dollar. When I want to send you dollars, I don't send you dollars. I instruct an American bank, which is a proxy to my Indian bank, to say, I'm going to pay my Indian bank Indian rupees. The Indian bank is going to tell this American bank, listen, I have an account with you in dollars. Why don't you transfer so many dollars to Shrey's American bank in that sense through the same route, and Shrey gets some dollars in his account. It's the money sits in America all the time. It's just money that's moved between two American banks. So they have a knowledge completely of what we are doing with each other, simply because we're using Swift transfers to make this is gone. To that extent, Russia's out of the system. China's running their own thing. India has UPI, which it could internationalize to do something meaningful. I think we should be doing a lot more of this. But I think it is impossible for me to predict a time frame when it will happen. All I can say is, every time I've said this, that we should do this, it seems like at least it's another decade away. We are taking steps very, very, very slowly. We haven't opened up. We even went backwards. We allowed rupee trading to happen in currency derivatives, and then somebody at RBI found out that, I think, that FEMA is being violated by allowing people to trade without them having actual underlying exposure. So they banned the use of currency derivatives in exchanges without proving that you have a dollar exposure. It's not like I can say that, oh, listen, I drive a car which uses petrol, for which you have to buy crude, so therefore I have a dependence on.
Which you do, but
yes, but they're like, no, you need to have a dollar invoice or importing dollar something for this to happen. So we've gone backwards on this internationalization piece, where we should have been using the rupee more for trade. It's finally happening in small steps. I think the first step has been allowing non-resident non-Indians to own rupees through their banking partners, which was earlier very painful. So in that sense, so now they can own this through something called Vostro accounts and all that stuff, and you can use those rupee balances now to do only two specific things. You can use it, for instance, to convert back to dollars, for one thing, or convert back to whichever currency you want, or you could use it to buy government securities. Of course, the most traditional thing that it's used for is to pay for Indian expenses,
goods and services,
goods and services and all that, which is great, because that's great if I were to use that goods and services. The thing that will really internationalize it is if there are two such exporters in different places who are able to pay each other, even though both of them are non-resident, using rupees that are
in their
India,
accounts here.
Their accounts here. That's what true internationalization means. And that is when the rupee is actually being used as a trading currency outside of India. And that allows people like us to say, listen, I can export it to you in rupees. Pay me rupees instead. And somebody says, well, I'll find the rupees. I don't have them, but somebody else I know has them. I can somehow, ensure that rupees are transferred to you. I would love that. I know a lot of people who wouldn't, because they want the dollars. But I know that at some level, if the rupee was internationalized, our trade would absolutely explode, and our ability for us to be able to, both sell our services and our products would increase quite substantially. But predicting when this is going to happen, I think this is almost like I think these are not a prediction. It was hope.
Yeah, okay. So past criticism is a pretty fair. Okay. So that was it on my learnings. I'd now like to come to the second section of today's episode. I want to talk about is a slightly higher level thing from this is at Capital Mind, I think you said this initially and you said this constantly is don't predict, respond well, or don't predict, react, however to express it. And I think the point is you said, look, getting a prediction right is very difficult. There's like 3 different dimensions or something like that. So can you tell us what makes a good prediction? Why is it so hard to have? And one thing I felt is when I looked at those 17 years, I'm like, oh, so even if you knew in advance that COVID is happening or this is happening, that doesn't mean that you know how to make money off of it. And so that was quite alarming. So maybe just throwing this question to you, what makes a good prediction? Why don't you believe in predicting?
Yeah, so interestingly, I think I did a little bit of thought process on this, and somebody once wrote about this. You have to have 3 elements to make a prediction. How do I say it? I think to be able to hold someone to a prediction, you need 3 elements of that prediction, right? So and if you do only 2, you will sound like a great prediction person, and you will never be wrong. So 3 elements are that first, I need to get the direction of my prediction right, which means I have to say that the market will go up or down. Second, I have to give the magnitude right. That means it has to go down by 20% or more. So I'm giving you some kind of a handle saying 20% or more. The third thing is the time frame in which it happens. That means it has to go down 20% in a year. Now, down 20%, down is the direction, 20% is the magnitude, in a year is the time frame. If I did only 2 of these, let me give you an example. So it will go down 20%. It doesn't go down in a year. You come back to me and say, Deepak, you were wrong. I said go down 20%. It will go down maybe in the next year. I don't know. It will go down at some point 20%.
Bas abhi hoga.
Which is always a thing. So this is the value investor trap, which is a great company. It will go up, but it went down. No, it will go up now. Now it's even cheaper than it used to be. So that's the problem of reinforcements through that way. But the second part is I could say the market will go down in a year, but I don't say how much. So of course it will go down sometime. It's not a fixed deposit. At some point it will go down, and you can always say I was right. It went down, but it went down 2%. I was right. My point of the prediction is to be right. It's not to be to try and make.
You were saying it'll go up 20%. Okay, fine.
So if I say that it will go 5% in a year.
Yeah.
Now it could go 5% up or it could go 5% down. This makes no meaningful difference to you, but
it will move.
It will move.
Yeah.
So then it sounds like it's the right kind of prediction, right? So, but it's meaningless.
It will be a volatile year, I guess. That's how you put it.
So it's a volatile year. So the markets will go up unless they go down. Is the other form of a cop-out prediction, because that's almost like anything can happen. All 3 results are possible in cricket, and
it's only one of the 3.
So, but getting the 2 out of 3 right is the intensity or whatever, getting the magnitude of magnitude, time frame, and direction all at the same time is a folly. You should do only 2 of them. And I have tried as much as I can to exercise this folly by making random predictions that sounded right, and I've still been wrong. Like I have said the markets will go 10%, I don't know which direction. And guess what? They haven't even gone that 10%. So it's like almost like, how can you be wrong where you didn't even tried all 3 of these things? But at the same time, I would say one of the reasons why I feel that doing predictions is a bad idea is that A, you cannot benefit from it, and B, you don't know it. I mean, my own record shows that I'm a horrible predictor.
Although, you could have made a career on just the first and last year. But
in fact, many careers are made sometimes by just one big prediction. And, we've got...
sometimes movies gets made on
yes, with these things. So, you have the one-hit wonders in music, and you have the one prediction wonders in finance. So I would say one of the problems with this is that you still don't know whether you can make money. Or you could predict, like you said, you could have predicted COVID and you could have gone short. But if you didn't know when to go back long, you had no idea how to make money, and you lost so much money because all of the gains you made were lost very quickly.
That you were bankrupt by end of the year,
By
basically.
the end of the year. What if you had predicted the India-Pakistan war? And you would have
Stocks will
gone short.
fall, oil will go up.
Stocks will fall, okay. Forget so much. Stocks will fall 10%.
Yeah.
Stocks fell 3. You lost your money on whatever little bet you made on this thing, right? GST cut will happen. Stocks should go up like crazy. Yes, some stocks did go up, and if you knew which one, that would kind of help you. But by and large, the market didn't get affected too much. So I would say by nature, knowing how to make money off of a prediction is a different skill altogether, and it is all about probabilities and risk reward equations rather than getting something right. So it's like when you do prediction, you are either 100% right or 0% right. Now there should be no way in the middle. So prediction markets are typically binary in that sense. So I'm going to bet on a win or a loss. I can't bet on even
one team will be better than the other or something.
So I can't bet on these fuzzy things saying, oh, you know what, it was better by 60%. So I'll give you 60% of your money or whatever.
Margin of defeat will be less than last time.
Yeah, or something. Even those are binary answers. Everything that has a binary answer is not this thing.
Fair.
But when you go into the world of stocks, in the world of markets in general, you don't have to be fully right in order for a prediction to work out. You can say, I believe this thing has a 30% potential growth ahead of it. But if it does only 20, you're still doing okay. It's when it does -10 that you're not, right? So there's a fuzziness involved in this whole thing. I'd say the response to action is probably better than trying to predict that action.
So that was my question, which is so fine. You're saying predictions aren't super helpful. So right now also trying to predict whether there's a bubble, when it will fall, how much it will fall, maybe that's not the best thing. So then instead of predicting, what do you do instead? You respond. And
so you wait. So for instance, one of the things that you would say is, listen, I don't know when this bubble is going to burst. I don't even care.
I don't even know if it's a bubble.
But I don't even know if it's a bubble. So, but I know that I will identify forms of weakness that I understand. Because forms of weakness that I understand is the reason you don't short a stock that is going up a lot is because it has strength. But when it has weakness, it is much easier to go short on, because the natural flavor is to take the stock down and you're in the right direction at that time. The same thing I would say with the market as well. When it reaches a point where there is not so much buying happening to counter the even a small amount of selling, then you know the market's weak enough, and that news can drive it even more. There's sometimes a stock that falls 20-25% falls another 20-25% after that, simply because if you have the patience, because now it's got weakness behind it. It's easier to respond to that first sign of weakness, lose that first, maybe you lose another 20% or 10% in some stocks when it falls, but you've ridden up the bubble and you've made your money, and you've made more than your money, and you get out when the time is right. And sometimes you leave enough money on the table as well. But it's fine. It's perfectly fine to be this thing like that. But I think I did this equation on a stock, and this is before the mutual fund, so I can actually talk about it. There was a stock which I talked about saying we bought this at 900 rupees. It's become 5,000 rupees. That's pretty much met my wildest predictions. And one of the responses I got on Twitter was, "Why don't you sell it?" I said, "I don't know if this is the end." They're like, "No, but that's how much you value it at." I said, "That's the stupidest reason to sell a company, because you think it's valued enough, because there is no reason the market has to agree with you." Then the stock goes to 8,000. I write it again saying, "Listen, I didn't sell it that time, but look at this, it's gone to 8." And from 5,000 to 8,000 is a 60% jump. And somebody's looking at me saying, "Now you should sell it." I am like, "Why?" "Because it's way worth more than you're valuing it." I said, "Who cares about what I am valuing it at? Somebody in the market is valuing it higher." So if I own it, I haven't bought it at this point, but I own it. So it's a tiger, so let me ride it. Why am I making the prediction on that this will the time when it falls? It did go to 16,000 after that, and it fell to 12, and that's when I kind of sold the stock. But the part of the story was that the person who's sitting there saying that I should have sold at 8 never changed his mind, despite the fact that I actually sold at 12. he's like, no, if it's overvalued, you should sell it. I'm like, why is my estimation of a company's value greater than the market's estimation of whatever it is? I don't care what it is. If the market corrects, that's the right time to use the time to sell. I think that should apply in predictions of any sort, is when instead of trying to make that prediction that is what's going to happen and place your bets on that happening, say that if this happens, then my prediction is sort of coming true. That's the time when I'll bet on it. So if I wanted to bet that semiconductors is going to become big in the country, one of the things I do want to hear is where are semiconductors used and what kind of orders do I want to see. So if India's cars start using semiconductors manufactured by this semiconductor company, that's when I know that the bet is really happening. So I can predict all I want, but until I hear that news, it hasn't happened. So let me use that as a crutch rather than losing my predictions as well.
I'd like to end the episode by just quickly going through your predictions that you made this time and just calling them out. And maybe a year from now, we'll see how these are. And we'll add a video to this annual letter writing exercise as well. So I have them in front of me. I'll go through them one by one. You can interrupt me whenever you feel you have something to say or just recap at the end. The first is India will see a big 20% up move and maybe even hit 30,000 on the Nifty before next Diwali. The next one is gold will crash more than 20% from the peak, silver too. I think you're halfway there on both of them.
And both of them, yes, but I feel that this was relatively easy as a prediction to make because I saw the same kind of euphoria that you saw in cycles. But I don't particularly feel that I will profit from this in any meaningful way. The only thing that I would have profited from it would have been if I actually managed to sell the little gold that we have, which we really want to get rid of. But I don't have the time to go and talk about this and find out that the gold is not exactly 999 or whatever it is and all that. But I would say here, gold is one of those things I've been wrong so often that you should take this with a massive pinch of, as much as you've taken everything that I've said with a pinch of salt, take it with more of a pinch of salt, because gold wise, I have been wrong in the last 1 year for sure.
The third one, the US will see a recession and inflation at the same time. So kind of like a stagflation like situation, hurting their ability to reduce interest rates meaningfully. Now it's not exactly contrarian, but it is a prediction. I mean, unlike the first two, this one is a little, you are putting your neck out there.
I'm putting my neck. I think what I'm trying to say over here is that they will reduce rates and then they will find inflation hurts them and they will not reduce it afterwards. This is pretty much how India started as well. India is seems to be 6 months ahead of the US in almost every of these things. We see inflation, we control it through interest rates. America sees inflation 6 years later, and they're like, oh my God, this inflation. And we've seen this before. So I think we've seen this drama before where we've said we will reduce rates, we reduced rates, we saw inflation come back, we held off on rates, and then inflation reduced afterwards, and then for that time. But Americans' inflation is much more complicated because it's self-induced. The tariffs have done something and a bunch of things. And as they get aware that their ability to influence the world economy is waning, that's when inflation is going to hit them the worst.
India will see a lot more investment happen domestically by investors into mutual funds and stocks. Foreign investors will slow down on sales, but by and large become less important for India's growth story. I think most people would agree with you on this one, right?
I think it's happening. It's easier to say that this is what's happening. So Deepak's just
you're extrapolating it into that.
But I feel that the amount of importance being given to FIS sales in the last 1.5 years has almost tired commentators themselves. They're almost like, I know FIs are selling, but does it matter? And the automatic answer is probably not, because you don't seem to be convinced it matters in the first place. So, that's what's happening right now. And I think that's going to become more and more, but it deserves it. Why should India not benefit from its own companies prospering?
Yeah.
Why are we dependent on foreign investment into our public markets for everything to go up? We have perfectly valid sources of capital. The rupee is a good source of capital for someone who earns in rupees and spends in rupees. So why are our rupee investments being kind of overshadowed by people who bring in dollars and want to take out dollars? So yeah, I think that's an easy one to make.
Last one. The rupee might hit 90 at some point, but will reverse to be in much happier territory by Diwali 2028.
Yeah, I feel this is a prediction I'm sticking my neck out on. This is not meaningfully,
Yeah.
there's no meaningful reason for me to say this, but I think one of the reasons that I'm saying this is because I just feel that we are at the cusp of a very critical point in this ecosystem where crude is no longer as big an export as it used to be. Import as it used to be. So because of that, we are able to reduce some of our dependence on it. And if we removed, forget full, if we removed just half the crude imports that we do, reduced, we would not have a current account deficit. Sure, some part of the current account deficit is hurt now because America has put tariffs on this thing and all that. But by and large, we still continue to get NRI flows and some of the other things and all that. And possibly as we reduce imports, the trade deficit will reduce. There's a trade deficit and a current account deficit. Trade deficit plus services, merchandise trade deficit, services trade surplus, uh, remittances. These are the three things that primarily form our current account deficit. So the other two elements continue to be positive. Services deficit continues to, surplus continues to be good, and remittances continue to be good. And I think remittances only increase because I think at some level, if you start introducing problems for people to emigrate and all that stuff, a lot of the money that people have abroad starts to come back because they're like, oh, we're going to have to relocate to India because they don't want us here. And that's going to, I think that's going to drive more in the short term. And if they do come back, they will create more of that domestic economy as a scenario, which allows us to say we don't need the imports or even the remittances anymore because you have a domestic economy that's serving itself. I feel that this circular piece, adding to the fact that India is growing slowly as an emerging consumer, not just a developing economy. We don't take aid. We haven't taken aid for the longest time, and so we don't need foreign aid at all. For that matter, we do get some. I think they kind of force it down on us, some past contracts and all that. But there is no need for us to have foreign aid at all. So to that extent, we don't really need as much in terms of foreign things. I say the reason it will go up to 90 is because the RBI is loath to protect it meaningfully. And they feel that perhaps by depreciating the rupee, we should help our exporters. But as we have found out, it doesn't help at all. If America puts 50% tariffs, there is almost nothing that you can do with the currency that will cause us to offset it. Instead, if those people who are exporting textiles were to just rewire themselves to sell to India, I'm sure it's a complex process because many times they sell to America the jackets that we pay 10,000 rupees for 2,000 rupees. And when there's an Indian demand for those same jackets at 10,000, you would imagine that they would still want to sell to India, but their lines are full. Their lines are full, taken up by the exporting service, exporting product mix. So they don't have time to service the Indian, or they don't have capacity to service the Indian market. So if we were to move that away, we would not need as meaningfully an export ecosystem in textiles as much as it is to serve the Indian and domestic market itself. If these switches were to happen, we might find that more investment comes into India just to counterbalance out this impact, because you're building a consumption economy that not only Indian producers want to serve, but also foreign producers as well.
Well, Deepak, I get it. Predictions don't matter that much, but I really do hope that your 2025 to 2026 predictions are as successful as the previous year's ones.
I hope so too. Thanks. And I'm happy Diwali. In probably 2 weeks delayed by the time you hear this, but I think this is probably the only time I'm going to be openly predicting something. Otherwise, I'm going to be shamefully
Hedging
and making statements like markets will go up unless they go down. So, but otherwise, yes, let's.
All the best, and let's hope your 30,000 prediction does indeed come true.
Yes, thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.